Stocks advanced once again last week with the S&P 500 notching its third straight weekly gain as the dollar also found its way back to winning ways, even as the November jobs report prompted more questions than answers for market participants. Another busy week awaits this week with US CPI highlighting the data calendar and 4 G10 central bank decisions due as well. It's another busy show on the trade-off this week, so without further ado, let's get into things. So there's about 2.5 trading weeks left of 2024, and this is, of course, our penultimate trade-off show of the year, but that certainly doesn't mean that things are winding down for Christmas just yet. Joining us, as always, our resident Santa Claus, my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. How are you doing? You survived the storm at the weekend, I assume.
Yeah, just about. A few trees down near where I live, and some bamboo fencing I've got up. Took a bit of a bashing, but touch wood, we've come through it unscathed. I hope you have too, mate.
Yes, just about. It was rather blustery over the weekend, and perhaps a storm awaits the financial markets this week with everything that's going on.
Oh, I'm already ready. I'm already ready.
Oh, no.
We're 30 seconds in and he's getting the cards out. You're never going to make the end of this show, mate, at this rate.
Well, no, I'm going to resign from the trade-off now, and we'll go to Topical Thunder, where Ryan can take you through everything that's going on. Sadly, I'm not allowed to leave the show. I'm under a contractual obligation to be here and also to provide some puns. So what I will do is talk about the non-farm payrolls numbers, because, of course, the November US labour market report was the highlight of last week. And well, I guess it was a bit odd, to be completely honest with you. Let's just break the report down step by step, and then we can go through it. I mean, headline non-farm payrolls rose by 227,000 in November, which was marginally above the 220,000 consensus and marginally below my own guess of 235,000, which, Ryan, you'll be pleased to confirm, I'm sure, put me in third in the Forex Analytics sweepstake. Is that right?
Yes, that's right, Michael. Well done.
Well, come on. Normally I'm third last, which is where West Ham find themselves most of the time. So I'm allowed to celebrate a small victory when it comes. In any case, the headline non-farm payrolls number was also boosted by a net upward revision to the prior two prints of 56,000, which takes the 3-month moving average of job gains to its highest level since May. Sticking with the establishment survey earnings, they rose by 0.4% on the month and by 4% on the year. Both of those prints being unchanged from the level that we saw in October. But it was the household survey which provided some degree of cause for concern, with unemployment rising to 4.2% and actually on an unrounded basis being perilously close to the cycle highs of 4.3% that we saw back in July. And of course, that came as labour force participation fell to 62.5%. So the message there is more people unemployed, fewer people in the labour force looking for work. Now, the market has taken that as having dovish implications for the policy outlook. This morning, the OAS curve in the United States pricing as much as an 85% chance that the Fed will indeed deliver a 25 basis point cut at the December meeting next Wednesday, and also pricing in around 90 basis points of cuts over the next 12 months, compared to about 75 basis points pre-release. Now, I think really this does cement the idea of a December cut, and I'm keen to get your view on this, Ryan, because I think there's a bit of a delicate tightrope for Powell to walk here. The market's got it in its head, and I know you're going to talk about inflation in a second, but the market's thinking we've got upside inflation risks and more hawkish policy risks going into 2025. But in the here and now, we're also kind of scratching our heads going, is the labour market starting to weaken? And I think the Fed will potentially want to head that off next Wednesday.
Yeah, I think the market perhaps maybe reading a little bit too much into the employment side of the mandate with this one. It was a rise in the unemployment rate. You know, if it had gone to 4.4, 4.5%, then I think the market would have been justified in the moves that we saw. But, you know, we've been around this level for long enough now. It was a decent bounce back in those headline numbers around expectations. So, yeah, we're back to where we started, sort of thing. So I don't know why the market got sort of a bit uber dovish over that number. And what does it do from here? Powell has told us they're going to cut. So the question is whether they do so or not.
Indeed. I think the simple reason the market got all excitable is it's December, things are very thin, and therefore markets do have a bit of a tendency to run away with themselves more than we might otherwise see. Anyway, that's one of the key events before the FOMC navigated. The other is, of course, Wednesday's US inflation figures.
Yeah, and obviously, while we know employment is key for the Fed, particularly right now, because they had that switch a few months ago into talking about unemployment. They've also keeping their eye on this stalling inflation that we've seen. Since hitting 2.4% in October, it bounced inflation to 2.6% last month and is expected to rise again to 2.7% year on year. The core has stayed in a pretty steady range between 3.2 and 3.4% since May. That's expected to stay at 3.3% again this month. Now, services, which includes this much talked about services cost, needs monitoring still, as that's really been the main thorn in the Fed side. That's still running hot around 4.8% year on year total for services. The housing shelter aspect of that is running at 4.9% year on year, so still quite toppy numbers. Now, this is one of the reasons why the Fed have been a bit more cautious in their forward guidance, even talking more and more about taking things slowly. We had Fed members on Friday echoing that same sentiment. Now, compared to the ECB, who have members cheering victory over inflation every week, it seems, the Fed aren't ready to start waving that flag just yet, and could even be worried that they may see a reignition of inflation pressures, as Bowman pointed out on Friday as well. Now, at the moment, their dual mandate is really finely balanced. While the NFP may make the case for continued cutting, the CPI data coming in much hotter than expected this week could keep the market on its toes for a pause. And given Powell's last remarks, which I saw was actually very bullish and undovish, a pause may still be a valid option for the Fed this month.
Are we back to that again? Undovish? Are you
Yes,
still trying to coin that as a phrase?
I've coined it. It's in the books, mate.
Your books, maybe, not mine. I would disagree, actually. I don't think there's much chance that they do anything other than deliver a 25 pip cut in December. I think you would have seen a much more concerted push on Friday among those Fed speakers to kind of guide markets away from that idea, and maybe even some sort of stories out in the Wall Street Journal or similar as well. But I think they are going to deliver a cut towards the back end of this year, get 100 bips of easing in the bag for 2024, and then the January meeting is when they sit down. Of course, you've got a rotation of voters on the FOMC, which does tilt a little bit more hawkish next year, and also I think January is when they sit down and really say, right, this is where the economy is. Of course, you'll have had another jobs report, another 2 CPI data, and another PCE number by then, and the first few days of Trump's presidency too. And I think that's when the Fed really sit down and say, right, is it now that we begin to slow the pace of normalization? But I think the December meeting is not quite as sort of live or finely balanced as some might expect.
Well, I'm going to disagree with your disagreement slightly. My base case is that they do still cut, but my percentages on whether they cut or pause has come pretty close to 50-50 now, just based on the recent comments, the worries that a lot of these Fed members have shown. Powell himself, saying that the economy since their September forecast and meeting has done much better. He likes to drop in those little hints now and again. So I think it's perhaps closer than the market expects, and I think the CPI data is going to be the decider. If we get a hot one, if it comes in 2.8, 3.5% on the core, the market's going to go bonkers for a pause.
Yes, well, if you, dear viewer, hold a similar view to Ryan, firstly, comment below and tell me why I'm wrong. And secondly, there's probably value in that trade as markets price a cut at about 85% or so. So certainly one worth looking at, be it in rates or in the dollar. In any case, the Fed is a consideration for next week. We have 4 G10 central bank decisions to get through this week before we get to that FOMC meeting. Kicking things off on Tuesday morning in the very early hours is the Reserve Bank of Australia. That will, of course, be out by the time you watch this. So we're fully expecting the RBA to hold rates steady at 4.35%. And as we were talking about the other week, The RBA do not seem in any hurry to deliver a rate cut, despite the fact that the only reason the Aussie economy is growing is due to government spending and the fact that inflation is back in their target range. So it looks like the RBA are seeking the sort of wooden spoon of central banking award for doing such a terrible job. In any case, moving through to the remainder of the week, on Wednesday, we have a policy decision due from the Bank of Canada. Money markets now discounting a greater than 80% chance that the BOC deliver a second straight 50 basis point rate cut, and that comes after a very soft jobs report that we had out of Canada on Friday. Of course, it was overshadowed by the payrolls print from the States, but we saw unemployment rise by 0.3% to 6.8%, and we also saw earnings growth collapse to below 4% from just north of 5% in the prior month. So it feels pretty tough to bet against the BOC doing anything other than another jumbo cut. Thursday, we have the Swiss National Bank, and that is very finely balanced indeed. Money markets pricing it as about 45% chance for a 50 basis point move, 55% of a 25 basis point cut. The sell side consensus very much favouring a 25 basis point move, but of course, inflation in Switzerland is still below 1%, which is the bottom of the SNB's target band, and policymakers recently did refuse to rule out taking rates back into negative territory. And I think if the RBA are taking home the wooden spoon award, then the SNB are taking home the little silver plaque for being the most dovish G10 central bank. Rates are already at 1%, and they're in a hurry to get back to that zero lower bound, it would seem. And then last but by no means least, on Thursday, we also hear from the ECB. A 25 basis point cut is the likely outcome from Lagarde & Co. And I would expect that to be the outcome at every meeting between now and next June, when they get back to a neutral level of around 2%. I think the big questions with the ECB are, firstly, is a 50 basis point cut discussed this week? You would certainly expect that it will be, even though it's unlikely to be delivered. And that confirmation of that could come from either the press conference or sources reports after the announcement itself. And of course, the other thing to bear in mind, as we were talking about previously, is that 2025 conversation around do they actually need to take rates below neutral. And I think given the political shambles that France has descended into over the last 5 days, added to the issues in Germany and the issues in China and geopolitical tensions and all of the trade issues that could come as a result of Trump's presidency, it is looking pretty damn likely that they're going to have to go into outright easy territory at some point towards the middle of next year. So a busy week of policy decisions coming up. Ryan, out of all of that lot, what are you focusing on the most?
I'm going to focus on the RBA and the Bank of Canada in my later topics when I talk about the currencies. The SNB, yeah, it's a difficult one for those guys. You know, they didn't see inflation going as high as everyone else. They didn't hike as high as everyone else, but they seem to be intent on bringing rates down as fast as everyone else. So, yeah, we'll probably get a lot of waffle about the currency as usual. This is the first meeting under the new guy, so that gives us something new to listen to. But so far, he's been pretty much torn from the same cloth as Jordan, so maybe we shouldn't get anything from that. The ECB, yeah, I've been saying it for a while now, it's the same as you. I'm expecting next year the ECB to start taking rates lower than the market expects, although a cut every month until June sort of falls in with that. They will go lower than they expect and they will want, and that'll be a problem for the euro, obviously. But a lot of these meetings is not going to be so much about what they do now, it's about what they tee up for 2025 and their expectations for that. So that's going to be probably the main thing to watch from all these banks.
Yes, indeed. I completely agree. Right. Well, I believe you're going to deliver us a bit of festive cheer, or are you going to be the Grinch?
I'm never a Grinch, mate. You should know that by now.
Around it.
Yeah, you're always a Grinch. Yeah. Oh, look, you've even got a little Christmas logo up there. Very nice. Very nice. So you go. I have to say that December is probably my least favourite month to trade of the whole year, because we always have a ton of central bank meetings where nearly everything, as I say, is about what they're going to do next year, more so than what they're going to do at those meetings. It's also a holiday shortened month and one where we get pockets of low liquidity coming in. It's also a big month for fund managers and investors to close up books for year-end reporting. And all of that really sometimes makes it very difficult to trade, and it sort of can paint a bit of a false picture with some price moves. So the advice I give traders at this time of year, and particularly during the holiday weeks, is to note the fundamentals as they stand throughout December and what the central bank decisions are and how they are set going into next year. Then look for any trading anomalies that push prices out of sync with those fundamentals. For example, we know the US is still ticking along nicely. We know the Eurozone is in a slump, and that's not going to change this month. So if year-end flows seem to drive euro dollar much higher, say 108, 109, maybe even higher, then it's likely a move that's out of kilter with the fundamentals and therefore a potential trade to look at once markets come back in January. So the long story short is that over the last few years, we've seen moves happening at year end that then go the other way once markets come fully back in the new year. So keep your eyes peeled and don't trust anything.
No, I think that's very sage advice. I mean, you say rightly, it's your least favourite time of the year to trade. I think it's probably most people's least favourite time of the year to trade, and that's why a lot of people don't. And that is why we tend to see, and I know we remarked about it previously. The tail end of November is when a lot of people close up, square off their positions and close up their books, and then come back in January. I think the key sort of takeaway for December trading for me is that nobody is going to make their year in December. But it's very, very easy to break your year in December. And a lot of people from a simple risk management perspective go, it's not worth the risk, especially when, as you say, we've got thinner than usual conditions and a boatload of event risk crammed into 3 very, very hectic weeks. Why would you take the risk? It boggles the mind.
Yeah, it very much does. And if I wasn't doing this show, I'd probably be taking the time off myself. So thank you for keeping me at my desk, mate.
Oh, well, that's all right, mate. That's all right. Don't you worry. I'm more than happy to oblige on that front. And we're going to keep you here a bit longer because we want to get into some charts. Well, let's kick things off with a look at the S&P 500. It does look like the market is setting up for a Santa rally to term a cliche, or coin a cliche, if I get my bloody words out. The market notching fresh record highs to close out last week, and the S&P actually has now closed at a record high on 57 separate occasions this year, which I think equates to about 1 in 4 trading days, and is actually the 4th most of any calendar year. So it has been a very, very strong year indeed for the US equity market, and all 3 legs of the bull case that have powered the market higher for that period remain intact. Economic growth is still strong, earnings growth is still strong and likely to remain so, with the consumer still in very, very good health, as shown by the earnings component of that payrolls report on Friday. And of course, we still have the Fed put lingering in the background as well. Now, we've spoken a lot about two-sided risks into 2025. It's true of monetary policy, it's true of fiscal policy. I think it's also true of the equity market, but that is a story for next year. For now, it seems that the market is focused more on end-of-year flows and a little bit of portfolio window dressing in the mix as well, with, of course, seasonal trends typically positive at this time of year too. So the bulls firmly in command of things, and well, if we were to see any dips, then the question, I suppose, is it a buying opportunity? Probably is, or is it something where actually conviction is lacking a little bit as we move towards silly season over Christmas? But certainly for now, I think the S&P has got a little bit more juice left in the tank before the end of the year.
Yeah, I think you need to make a New Year's resolution on this one, mate, because this is probably about the 60th week you've spoken about S&P making all-time highs. So I can't help it. But this has gone up, particularly year ends. This has gone up when we've been in cut cycles. It's gone up when we've been in hike cycles. It's the same old story. What will make this go down? We even had, a few economic wobbles, and it's still gone up. So I really don't know what changes this at the moment. It's really a close your eyes and buy the dip type trade, and that's what a lot of people are doing at the moment. Eventually, we will see a proper pullback, whatever causes that, whether it's Trump, whether it's trade wars or whatever goes on, something will happen. So there's plenty of juiciness to come in the new year, and we'll see how stocks get through that.
Indeed, yes, only time will tell. Right, moving on, there are 2 pairs or two crosses, I should say, in the FX space, where if you zoom out over the last decade or so, they are effectively a flat line, one of which is euro sterling. The other is what Ryan's looking at here.
Yes, one of my snail pace crosses that I like trading at the moment. Now, I did put this setup or together Sunday night, so we're going to have the RBA out before you obviously see this. I'm going to try and do a bit of forward guidance, as the central banks like to say, and plan what might have happened by the time you see this. Now, given the RBA meeting this week, sorry, mate.
I said, hopefully you do a better job than they do.
Oh, I could do that with my eyes shut better than those clowns can do, but I digress before we get into that rant. So, yeah, given the RBA this week, I'm looking at Aussie Kiwi again. This is a trade I've talked about several times on the show, and I've been short since early October, trying to catch a turn in the RBA stance. Now, pre-RBA, it seems that the market has also been jumping on the same theme and starting to think that the RBA is going to have to start turning more dovish. Hence why we've seen Aussie getting sold off quite significantly. We've moved away in this pair from the recent highs, and I think we're in rally selling phase at the moment. So if the RBA are still sticking to their undovish guns, this has probably rallied up to near 110, maybe even over. If it has, then I think the rally is valid for shorts to run into a dovish term from them going into 2025, and that's something I'll be looking to do to add back to my short positions. Conversely, if they have turned a bit more dovish at this meeting, we will probably be trading closer to 109 or maybe even below. And then the trade is all about that big 108 magnet that I've been speaking about. Now, that's somewhere where I'll be booking some profits if we get down there and close to it. Now, a dovish tilt will keep the pair in a rally selling mode as well. So from that point, rallies to maybe 109, 40, 50 will likely find plenty of trouble and plenty of sellers. Overall, I see little scope for this to rally all the way back up to those recent highs unless we get some year-end flows involved, or the RBA has indicated a cutting path that has then killed the expectation trade. Because a lot of what I trade regarding central banks is the expectation side of things, not when they actually decide to deliver on those expectations. So I'm sticking with the short side for this one.
Yeah, I think I will join you on that one, to be completely honest, mate. I think the divergence between the RBA and the RBNZ is quite striking because, you know, the RBNZ have clearly realised that they want to get ahead of the curve. The RBA are looking at the curve disappear off in front of them and wondering how far behind said curve they can get before being forced to act. So, yeah, I think downside is the likely direction of travel here for me.
Oh, good stuff. Now I've got you on my side. I think I might get out to trade.
For God's sake. Right, let's move on. Let's have a look at the euro. Lots going on in the Eurozone last week. We alluded earlier on that the French government lost that no confidence vote. Of course, you've still got Germany heading for elections next year, the ECB sounding very, very dovish indeed, and a whole lot else going on besides, including more dismal economic data and, of course, geopolitical tensions lingering as well. To be honest, the euro hasn't appeared particularly bothered by that. We're still trapped in this range between about 104.5 to the downside and 106 to the upside, with that key 105 level that Ryan has harped on about this year almost as much as I've spoken about as the S&P. That 105 is still the key pivot in the middle. And I think this is really just a case of waiting and seeing. The payrolls print on Friday wasn't enough to force us outside of this range. We will see whether the US CPI data on Wednesday or the ECB decision on Thursday can do so. But this is a classic case of have your levels marked out, wait for one to break on a closing basis, and then follow that trend to the upside. You'd look to 107, to the downside, you'd probably look to those lows that we saw after the November flash PMIs at 103.35. And until then, I would be sitting on my hands, proverbially speaking.
Yeah, and I think the price action Friday was very, very important. I mean, I spoke about the euro dollar last week on the show, and throughout the week, I was continuing to be short. But even I was sitting thinking this just looks like it wants to have a crack at that 106 level, and the NFP was the job that finally broke it. But as I've been saying through the week, where it closed was very important. It's okay busting up through a level, clearing out the stops, but if you can't hold that break, then you go back in the box. We've gone back in the box after that 106 break. and we're struggling to get back up to that 106 level again. What I would say, though, is if we get a secondary move above 106 pretty quickly, say today, being Monday, or maybe tomorrow, that move might have a bit more substance to it, and then we might see a further push up towards that 107 level. But if we do test it and can't get through, then I'm afraid we remain well in range.
Yes, indeed. Right. Well, we've spoken about the RBA. We've spoken in passing about the ECB. What have we missed? The Bank of Canada.
Yeah, the good old syrup swiggers over there. We're going to talk about those as well, and dollar CAD.
I really wondered where that was going for a second.
I caught you off your guard there, didn't I? So
dollar CAD rallied, all the rest of it.
Rallied very hard on Friday after their jobs data and unemployment really jumped in the Canadian report. Now that the market sold the CAD on that rather than bought it on the double the expected gain in employment really stood out to me. As Michael suggested, the BOC expected to cut another 50 pips, and apparently the data was the icing on the cake for those expectations. However, like the US, Canada has seen a bit of a jump in inflation the last few months, especially in their core number. Now, having already cut 125 basis points since the summer, if they take that to 175 of cuts this week, that might be seen as maybe running too far too fast. So if they do potentially surprise and slow down with a 25 or even an outlier pause, which I don't think is going to happen, that's not my base case, then I think the loonie is going to see a bit of a big gain, and we could see some chunky move to the downside for this pair. Now on Friday, dollar CAD hit the stretch point up in the 141.70s again, and there's a risk that if we do get a less dovish Bank of Canada decision, that could send this much lower, maybe even below 140. And even if they do go another 50, they might indicate from that point a slowing or a potential pause upcoming for early 2025. So, that could produce the same outcome from the pair, and we see it heading lower as well. Now, whether such a move would be enough to break the trend that we've seen over the last few months is another question. But I think maybe the market is underpricing the potential risk of a less speedy BOC this week.
Well, that's certainly something worth considering. As you say, it does look, in the market's view at least, as if 50 is a done deal after the jobs data. What I think is quite interesting is how this 141.75, 142 region, the 4-year lows that we hit after that Trump sort of surprise tariff announcement, that looks like a very, very tough nut to crack to the upside. Obviously, we had that attempt on Friday. We also had an attempt when those tariffs were announced. So if we do manage to get through that level, then there could be plenty of room to the upside here as well.
Oh yeah, absolutely, and we could be heading up towards the huge double top, which you can't quite see there, up in the 146s, and that's a real doozy of a level. So yeah, it's all to play for.
Indeed it is. I assume Ryan will get his crayons out and zoom out, and we can have a look at that next week. In the meantime, let's get on to our plays of the day. Right, 2 commodity-related plays for you this week. I'm kicking things off with a look at gold, because for 10 days or so, the yellow metal has gone absolutely nowhere. And the fact that I've brought it up on this video this week means that it's probably going to start jumping around all over the place the second we hit stop recording. In any case, that range is between about $2,600 an ounce to the downside and the 50-day moving average, which comes in around $2,670 to the upside. For a fundamental perspective, it's a little bit tough to argue for a decisive break either way, although we did see treasuries rallying across the curve last week, and I suppose China beginning gold purchases once again in November may also support the case for upside. As with my euro dollar view, this is very much a sort of wait and see trade. If we get a closing break north of the 50-day moving average, that's when you step in and buy, and when the bulls are likely to come back into the market. And if we get a closing break below 2,600 or even below the 100-day moving average, which is lurking just below that, then you'd argue that the bears are back in control, looking towards those November lows around 25.30. So again, a couple of decent levels to have on the radar. Wait and see, and let price be the guide, I think. Ryan, Brent.
Yeah, well, firstly, you might be a bit of a Nostradamus on this one because we're sitting here trading 26.69 at the moment, so we're right up against your moving average in gold. So you might have this trade might be dead by the time everyone sees it. But at least you called it right. I'm your witness to that one. Yes, I'm going to look at oil for this one. And looking at Brent Crude particularly this week, when you see a chart or when you see price action where the highs keep getting lower and we keep testing a level more and more, it tends to indicate that a break is coming. So Brent Crude has seen rallies hit all year long, over a year now, and there's been a last phase since October where we've seen a mini version of that, so that the highs coming lower and lower and lower. So my play today is looking at potential break trade short through the $70 mark. We do have this level at 71.65 marks on the chart there. There's been a few extensions under that down to sort of the 71 area, but it's going to be a break of 70 that really seals the deal for me. I'm looking at two ways to play it. Go with an initial break of the $70 level or wait for a break and then maybe a confirmation hold if we bounce and retest that 71.60 area. So, looking for a breakdown for me this week.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to Kyriakos for deciding to not take holiday and actually show up this week. All three of us will be back with our final episode of the Trade-Off of 2024 this time next week. In the meantime, thank you very much, as always, for watching. I do hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and how you're viewing things into the last few trading days of the year, and we will be back this time next week. Thanks as always for watching. Goodbye for now.